Donald Trump says he will hit China, Mexico and Canada with new tariffs on day one of his presidency, in an effort to force them to crack down on illegal immigration and drug smuggling into the U.S. The U.S. President-elect said he would sign an executive order imposing a 25% tariff on all goods coming from Mexico and Canada, after being inaugurated on the 20th of January 2025. He also said, "We will be charging China an additional 10% tariff, above any additional tariffs, until it cracked down on fentanyl smuggling." The threat could mark a major escalation in tensions with the US's three top trading partners. It could also lead to higher prices for Americans, since tariffs work as a form of tax on imports. The measures have the potential to cause disruptions to the global supply chain and would hit the three countries targeted by the tariffs hard. The tariffs on Mexico and Canada will remain in place until the two countries clamp down on drugs, particularly fentanyl, and migrants illegally crossing the border, Trump said in a post on his Truth Social platform. Both Mexico and Canada have the absolute right and power to easily solve this long-simmering problem, he wrote. It is time for them to pay a very big price. In a follow-up Truth Social post, Trump attacked Beijing for failing to follow through on promises that he said Chinese officials made to carry out the death penalty for people caught dealing fentanyl, a synthetic opioid. The Biden administration has been calling on Beijing to do more to stop the production of ingredients used in fentanyl, which Washington estimates killed almost 75,000 Americans last year. During his election campaign, Trump threatened Mexico and China with tariffs of up to 100%, if he deemed them necessary, much higher than those he put in place during his first term in office. Trump has also said he will end China's most favored nation trading status with the U.S., the most advantageous terms Washington offers. Last year, more than 80% of Mexico's exports went to the U.S., while around 75% of Canada's went to its larger neighbor. Even after years of a bitter trade dispute between the world's two biggest economies, the U.S. still accounts for about 15% of China's exports. How do tariffs work? A tariff is a domestic tax levied on goods as they enter the country, proportional to the value of the import. So a car imported to the US with a value of $50,000 subject to a 25% tariff, would face a $12,500 charge. Tariffs are a central part of Trump's economic vision. He sees them as a way of growing the US economy, protecting jobs and raising tax revenue. He has previously claimed that these taxes are not going to be a cost to you, it's a cost to another country. The charge is physically paid by the domestic company that imports the goods, not the foreign company that exports them. So, in that sense, it is a straightforward tax paid by domestic US firms to the US government. Trump imposed a number of tariffs in his first term of office, many of which have been kept in place by his successor, President Joe Biden. Economic studies suggest most of the economic burden was ultimately borne by US consumers. It was not immediately clear whether Trump's additional 10% tariff, above any additional tariffs earmarked for China, were on top of the 25% he was planning for Canada and Mexico. What is Trump's strategy? The move is clearly consistent with his promise that he made during the campaign to utilize tariffs as a weapon to accomplish many of his policy initiatives, Stephen Roach, senior fellow at the Paul Tsai China Center of Yale Law School, told the BBC's Business Today program. Trump's pick for Treasury Secretary, Scott Bessent, has previously suggested that the president-elect's threats to impose major tariff hikes were part of his negotiating strategy. It comes as the Chinese economy is in a significantly more vulnerable position than it was during the previous Trump presidency. The country has been struggling with a number of serious issues, including an ongoing property market crisis, weak domestic demand and growing local government debt. The new tariffs appear to break the terms of the US-Mexico-Canada Agreement (USMCA) on trade. The deal, which Trump signed into law, took effect in 2020. It continued a largely duty-free trading relationship between the three neighboring countries. After issuing his tariff threat, Trump held a conversation with Canada's Prime Minister Justin Trudeau in which they discussed trade and border security, a Canadian source familiar with the situation said. Trump's announcement sparked a dollar rally. It rose 1% against the Canadian dollar and 1.6% against the Mexican peso, while share markets in Asia fell, as did European bourses in early trade. On China, Trump accused Beijing of not taking strong enough action to stop the flow of illicit drugs into the US from Mexico. The embassy also cited steps it said China had taken since a 2023 US-China meeting, after which Beijing agreed it would stem the export of items related to the production of the opioid fentanyl, the leading cause of drug overdoses in the United States. Chinese Foreign Ministry said in a statement that China was willing to continue anti-drug cooperation with the US on the basis of equality, mutual benefit and mutual respect. Chinese Vice President Han Zheng, speaking at a supply chain expo in Beijing on Tuesday, said China was ready to work with other countries to build an open world economic system and maintain the stability of global industrial and supply chains. China's economy is in a vulnerable position amid a prolonged property downturn, debt risks and weak domestic demand. In the run-up to the November 5 election, Trump floated plans for blanket tariffs of 10% to 20% on virtually all imports. He also said he would put tariffs as high as 200% on cars coming across the US-Mexico border. Trump's overall tariff plans, likely his most consequential economic policy, would push US import duties back up to 1930s levels, stoke inflation, collapse US-China trade, draw retaliation and drastically reorder supply chains.